welcome back to our mortgage education series. In today's episode, we're delving into the exciting world of mortgage types. Yay! Fixed, tracker, variable sounds confusing, right? Well, don't worry. By the end of this video, you'll know exactly which type might be the best fit for you. So, let's get started. Now, imagine these coffee cups represent different mortgage types. Each one has its own unique flavour, and it's all about finding the one that suits your tastes. First up, we have the fixed rate mortgage, just like your favourite coffee order that never changes. And mine, if you're buying, is a oat milk latte extra hot. A fixed rate mortgage means your interest rate stays the same for a set period, usually 2, 5, or even 10 years. Now, you could potentially get 15 or 20-year fixed rate. What this buys you is predictability, so you know exactly what your monthly payments will be. The pros, it's great for budgeting because you won't be surprised by any rate hikes. The downside, if interest rates do fall, you could end up paying more than you may do with a variable rate. Also, they usually come with early repayment charges. Now, early repayment charges, or you might see them as ERCs, are fees that a lender may charge if you repay your loan or mortgage earlier than the agreed term. In essence, an ER fee is a fee for paying back your loan early. So, in effect, you're compensating the lender for the interest they won't receive because of the early repayment. Most lenders now allow you to repay 10% per annum without penalty. There are some that will allow you to pay 20%, and there are a couple that are more flexible. Next, we have the tracker mortgage. This one follows the Bank of England base rate. It's variable, so a bit like a roller coaster, it goes up and it can come down. Your interest rate therefore can change, but it tracks that base rate closely. The pros, of course, if the base rate goes down, your payments go down too. They can also be more flexible because a lot of them come with no early repayment charges. The downside, if the base rate rises, so do your payments. So it can be a bit unpredictable. It can save you money when rates are low, but costs you more if rates go up. Finally, we have the variable discount rate mortgage. This one is set by your lender, and so it can change at any time. Think of it as like trying a new coffee blend every month. Sometimes it's a hit, sometimes not so much. The pros, these often also come with more flexibility, like the option to overpay or leave without hefty penalties. The cons, I would say it's probably the most unpredictable of the three, and rates can change at any time. So you need to be prepared to take some interest rate risk. So, which one is right for you? Well, here are some tips. It's all about your attitude to risk, and that means yours. So, not your friends, not your mates in the pub or down the gym, yours. I'd always obviously advise speaking to a professional mortgage advisor. If you like stability and knowing exactly what you'll pay every month, a fixed rate mortgage might be your best bet. It's especially good if you're on a tight budget or just like to plan ahead. Think of it like an insurance policy. You paying for that security. If you're comfortable with a bit of fluctuation and want to take advantage of potential rate drops, a tracker mortgage could be for you. It's a good option if you're willing to take a bit of risk for possible savings. And if you value flexibility and are prepared for rates that can change, a variable discounted rate mortgage might be the way to go. This can be ideal if you plan to overpay your mortgage or might move before the fixed term ends. But remember, choosing the right mortgage is all about finding your perfect match. Think about your financial situation now, your future plans, and just how much risk you're comfortable with. And of course, talking to a mortgage broker can really help tailor your choice to your needs. Thanks for watching, and don't forget to hit that subscribe button so you don't miss our next video, where we'll help you figure out just how much you can borrow. If you've got questions in the meantime, drop them in the comments below. See you next time.